Take $100,000 of your savings and put it in a bank account. Now take $250,000 and buy Bitcoin with it. This summer, walk both of them into the same mortgage office. The bank account gets you a $100,000 down payment. The Bitcoin, 2.5 times as much money, gets you the same $100,000. That is not my estimate. That is the published term sheet on the first mortgage of its kind ever written in this country. $2.50 of Bitcoin for every $1 of house. And that's the good deal. That's the door they opened. There's a second rule underneath it, one line long. It has nothing to do with the price of Bitcoin, and it decides whether your coins count at all. I'll take you straight to it in a minute. But first, the good news. Because the good news is real, and I'm not going to skip past it. In June, a couple in Ann Arbor, Michigan, bought a house using Bitcoin without selling a single coin. First time it's ever been done on ordinary mortgage rails in America. Here's exactly how it works, because the details matter. They got two loans, not one. Loan number one is a completely normal 30-year mortgage, the boring kind, backed by Fannie Mae. Loan number two is a separate loan that covers the down payment, and that one is secured by their Bitcoin, plus a second claim on the house itself. Coinbase holds the coins. A lender called Better wrote the paper. For 15 years, the answer to, "Can I buy a house with my Bitcoin?" was no. As of this summer, the answer is yes. That's real. People are closing on houses with it right now. It started with an order. June of 2025, the man running the Federal Housing Finance Agency, Bill Pulte, told Fannie Mae and Freddie Mac to stop ignoring crypto and start counting it. Those two companies write the rulebook every mortgage lender in America follows. When they change one line, 30,000 loan officers change what they do on Monday morning. So here is the line. This is the part almost nobody has read, and I'm going to give it to you word for word. To count, the order says, the crypto has to be, quote, evidenced and stored on a United States regulated centralized exchange, subject to all applicable laws. Read that slowly. Stored on an exchange. Bitcoin sitting in your own wallet, on a device in your own house, where you hold the keys and nobody on earth can move it but you, that does not meet the sentence. It isn't discounted. It isn't marked down. It simply isn't there. I keep the live Bitcoin price on the same screen as the mortgage numbers, which is how I caught this one. I'll come back to that. Now hold those two side by side, because this is the whole video. Bitcoin on an exchange and Bitcoin in a drawer in your house are the same asset. Identical. Same protocol, same 21 million coins, same price to the penny, same chart, same week. If Bitcoin falls 30% tomorrow, both of them fall 30% tomorrow. There is no difference in the risk. None at all. The only difference is who can reach them. And before you write me a comment, yes, there is a way around it. Two ways. You can move your coins onto the exchange, or you can sell them for dollars, park the cash, and let it sit a couple of statement cycles until it looks like ordinary savings. That's not a loophole in what I'm telling you. Sit with what those two options actually are. Option 1. Hand your Bitcoin to a company. Option 2. Stop owning Bitcoin. Those are the doors. Both of them end with somebody else holding your money. So let me argue the other side now, properly, because you deserve the strongest version of it and not a straw man. The lenders are not being unreasonable. They'll tell you a cold wallet fails two ordinary tests, and they're right on both. Test 1. Can we confirm it? An address on a screen proves a balance, not an owner. Anybody can show you a picture of somebody else's money. Test 2. Can we take it if you stop paying? And they can't. There is no sheriff who can make a man say a password. You cannot foreclose on a sentence somebody memorized. That's not a plot. That is lien law, and it's 400 years old. But hold on, because both of those tests already have an answer, and I gave it to you on this channel last week. Last week, I walked through how to store Bitcoin so a robbery bounces off it. And I told you the drawer done right still beats a vault with somebody else's name on it. I meant every word. Here's what I want to add to it now. There's a version of self-custody that answers the lender completely. It's called multisig. Instead of one secret controlling your coins, you make three, and any two of them have to agree before a single coin moves. It's the bank vault that needed the banker's key and yours turned together. So give the lender one of the three. He cannot move a coin by himself. He'd need you standing there. But he can prove the coins exist, and he has a real claim if you stop paying. Both of his tests answered. And you never hand anything over to anybody. That has been possible for about 10 years. Nobody has written it into a rule book. Put that in your pocket, because it comes back at the end. Now, I've conceded the whole argument, and I want you to look at what's left standing, because this is the part that turned this video into a different video than the one I sat down to make. The system doesn't count cash in your safe either. It doesn't count the gold bars in your basement. It doesn't count the silver in the coffee can. Bitcoin is not being singled out. Bitcoin just got added to a list. And look at what that list is. Cash in a safe, gold in a basement, Bitcoin in a drawer. Those are the only things in the world you can hold in your hands without asking anybody's permission. And every one of them is invisible to the financial system. It was never anti-Bitcoin. It's anti-you holding it. That's an old rule, and it's much bigger than a mortgage. If you were an adult in the 70s, you already lived the sharpest version of this. On a Sunday night in August of 1971, the dollar was fixed to gold at $35 an ounce, and by Monday morning, it wasn't. And here's the detail people forget. American citizens weren't even allowed to own gold bullion at the time. Hadn't been since 1933. The bearer version was the illegal version. So the pattern isn't new. What's new is that for the first time, there's a bearer asset that doesn't need a vault. Gold in a basement is honest money that can't move. To spend it or borrow against it, you have to hand it to somebody with a vault. And a vault needs a man, and a man can be leaned on. That's why gold lost. Not because it was bad money, because it was slow money that required trust. Bitcoin is the first thing anybody's built that's bearer and fast at the same time. You can hold it yourself and still send it around the world in 10 minutes. No vault, no truck, no man. That is why the rule had to be written. Not because they hate it, because it's the first asset in 400 years that the filing system genuinely cannot read. That live Bitcoin price I've been quoting sits on my macro command center at timtalksfinance.com/members. On the same screen as the mortgage numbers. Free, and not a delayed quote. Now let's talk about what all of this costs you. In dollars, because that's the only part that matters. Start with the 2.5 to 1. To borrow $100,000, you pledge $250,000 of Bitcoin, and those coins sit in the lender's account for the entire life of the loan, 30 years. Compare that to your house. A bank will lend you up to about 80 or 85 cents against every dollar of equity you have in your home, an asset with a county registry, a lien, a tax bill every year, and a government that can put a stranger's name on the deed. Your house borrows at 85 cents. Your Bitcoin borrows at 40. The system lends more freely against the thing it can take. And here's the piece I'd want somebody to tell me before I signed. Better says the price swinging doesn't hurt you. And that's true. No margin calls, no top-up demands, no forced selling when the price drops. They only take the coins if you miss payments for 60 days. But the coins are locked in their account for 30 years. So picture the bad week. You lose your income, and you're sitting on $250,000 of your own Bitcoin that you cannot touch to make a $4,000 mortgage payment. The thing that could have saved the house is the thing that's holding the house. You should also know this is a genuine fight in Washington, and that the loudest critics are not arguing my side. In April, Senator Dick Durbin and Senator Elizabeth Warren wrote to Pulte, demanding he cancel the whole program. Their complaint is that it's too permissive. They point out the combined cost runs about 1.5% above a standard loan, and they bring up the 2008 bailout, $189 billion of taxpayer money, roughly $1,400 out of every American household. So one side wants your Bitcoin counted through a company. The other side wants it not counted at all. Now notice what neither of them is fighting for. Nobody in that room is standing up for the Bitcoin you hold yourself. That version isn't on either table. When two people who agree on nothing quietly agree on one thing, that one thing deserves your attention. And this is not stopping at housing. 4 days ago, on the 18th of August, the Securities and Exchange Commission proposed a brand new rule book for issuing digital assets in this country. 60 days of public comment once it's printed, then it begins. Your stocks, your bonds, your funds, your credit, your home equity, it's all going onto digital rails. That's not a prediction. The schedule is public. So there's only one question left worth asking. Which one of these has no issuer? A tokenized bond has an issuer, and the issuer can sell more. A tokenized fund has a sponsor who can create more shares. A dollar stablecoin has a company that can print more of it. A digital dollar from the central bank has a printer and a switch that decides what you're allowed to buy. Your house has a county that can raise the tax and a lender who can foreclose. Every single one has a man who can make more of it, or a man who can take it away. Every one. Bitcoin has neither. 21 million. Fixed. Forever. No servers, only a protocol. And I want to be careful with the word fixed, because you have been sold that word before. Social Security was fixed, then they changed how they measure the raise. The dollar was fixed to gold, then one Sunday it wasn't. Those were promises, and a promise is only worth the people who inherit it. 21 million is not a promise. Nobody signed it. There's no chairman who can amend it, no bill that repeals it. It's the arithmetic every machine in the network runs, and every machine checks every other machine. To change it, you'd have to talk tens of thousands of strangers in dozens of countries, who mostly can't stand each other, into voting to make themselves poorer. Nobody has ever gotten that meeting on the calendar. That's the difference between a rule somebody keeps and a rule nobody can break. Now bring it home to your money. Say you've got $100,000 in the bank. The mortgage rulebook says that's worth exactly $100,000. Full credit. Inflation ran 3.4% in July. At that rate, that $100,000 buys about $3,300 less a year from now. Leave it 10 years, and it buys about $71,000 worth of groceries. You lose roughly $28,000, and nobody ever mails you a statement about it. That's the asset with a perfect score. And 2/3 of that inflation number, in July, was the cost of shelter, the price of having a roof, which is the thing this entire rulebook exists to finance. Meanwhile, the house itself. The typical American home sold for $434,000 in July, and sales fell for the second month in a row. 26 cents of every dollar spent on a home that month was straight cash, no loan at all. That is not young families stretching for a starter house. That's money looking for somewhere safe to sit. So the paperwork is telling you two things in the same breath. The house is money, and the Bitcoin you hold yourself is not. I'm not going to scare you into anything. There are no certainties here, only probabilities. And anybody who tells you different is selling something. Let me be square with you on the price too, since it's been a loud week. Bitcoin jumped about 22% in the week I recorded this, up to around $79,000, the best week in over 2 years. And it's still down roughly half from where it was a year ago. And most of that jump was cheap money and traders getting squeezed, not one new person deciding to save in it. Both of those are true. If I only told you the good half, I'd be doing what CNBC does. So, two scenarios. Scenario 1. This is just what modernization looks like. The rails get built, Bitcoin gets absorbed as a well-behaved product a company holds for you. It counts on your mortgage application, everything works, and along the way it quietly becomes a thing you have a claim on rather than a thing you have. The exit still exists, it just has a doorman now. Scenario 2. Every rule that discounts the bearer version makes the bearer version the only one that was ever different. The coins that stay in private hands become the scarce ones, and 21 million that nobody controls gets repriced against everything they can print. I lean one way, and you know which, but probability, not prophecy. 3 signals you can check yourself, no expert required. Signal 1, multisig. The 2 of 3 setup where the lender holds one key and still can't move a thing without you. Watch whether anybody writes it into a rulebook. It solves their problem and it costs them nothing. If they adopt it, then I was too suspicious, and I'll say so on camera. Signal 2. Watch what Fannie Mae actually publishes. Today, the written rule still says convert your Bitcoin to dollars first. If that never changes, the door opened less far than the headlines said. Signal 3. Watch that Securities and Exchange Commission rulebook after the comment period. See whether the final version treats an asset you hold yourself the same as one a company holds for you. That single distinction is the whole fight, in every market, not just housing. Here's where I land. The American mortgage system just told you in writing which kind of Bitcoin it can work with. It can work with the kind somebody else is holding. It cannot work with the kind you hold yourself. Don't read that as a warning about Bitcoin. Read it the other way. It's the most official confirmation you'll ever get that the one they can't reach is genuinely different from everything else on the shelf. They put it in a rule book and they put a number on it, 2.5 to 1. And you can still buy the version they can't reach today, at the very same price as the version they can. I don't think that stays true forever. It's true this morning. If you want the numbers I used here, the live Bitcoin price, and what inflation is actually costing your cash in dollars per year, take the 2-minute money quiz at timtalksfinance.com/members. Free, no credit card, and it hands you one move worth considering for your own situation. I built it so you don't have to work this out alone. 21 million. Fixed. No issuer and no keeper. That last part isn't a technical detail. Turns out it's the whole thing.